And we started with reverse mortgages, okay? So last week I gave you a basic overview of what a mortgage is. We talked about the definition of a mortgage. I explained how fixed interest rates work and how adjustable rate mortgage or ARM interest rates work. We discussed what PITI-HOA is. That's principal, interest, taxes, insurance, and homeowners association fees. We talked about how that works on a traditional mortgage. And we also talked about the two ways to build equity in your home traditionally, okay? So if you did not get that discussion, go back to the prior segment, all right? Then we began a discussion on reverse mortgages. So remember, for reverse mortgages, we said that the borrowers have to be at least 62 years of age or older. Traditional mortgage, all you have to be is 18 or whatever the age of consent is to sign a legal contract, okay? So for reverse mortgages, you have to be at least 62, and it allows the borrowers to tap the equity that's in their home, all right? So there are typically, with reverse mortgages, no principal and interest payments, okay? So remember, on a traditional mortgage, you're paying that PITI-HOA, principal, interest, taxes, insurance, homeowners association dues. Well, with a reverse mortgage, you don't pay the principal and interest payments, but you do have to pay the taxes, insurance, homeowners association dues, and you have to make sure you're making any repairs to the property that's needed, okay? Any maintenance or repairs, just like you would with a normal home, all right? So the principal and interest, because you're not paying it with a reverse mortgage, the principal and interest is being paid by the mortgage company to you, okay? And so using the home's equity, the principal and interest payment is paid to you in this type of mortgage, and that's why it's called a reverse mortgage. Instead of you paying the principal and interest payment to the mortgage company pays you the principal and interest payment. All right, so I think we're clear on that. So then, with a traditional mortgage, you make your PITI-HOA payments until the home is paid off, right? So you're making those payments, it's like an installment loan. You're making those payments until you pay the mortgage off. And then on a traditional mortgage, when you're making payments, your balance is going down, right? But the equity in your home, hopefully, is going up. So balance going down, equity going up in a traditional mortgage, all right? But with a reverse mortgage, the home is repaid when the borrowers no longer live in the home for whatever reason. Either they moved, they downsized, or unfortunately they passed away. So if there's one borrower on the reverse mortgage or a couple on the reverse mortgage, once none of the borrowers are living in the home, then the reverse mortgage has to be paid back, okay? So on a reverse mortgage, you don't make the principal and interest payments. Instead, the balance, instead of going down, it's gonna actually go up. And instead of the equity going up in a traditional mortgage, the equity is going down. So we talked about all of that last week. You can go back if you want to and take a look at that. And so basically, when you're dealing with a reverse mortgage, you have to remember that equity is important. And you have to have enough equity in the home to do what the goal of a reverse mortgage typically is. And what that is for whoever the borrowers are to have additional money to pay for their other living expenses, okay? So that's how that works. So now, I just want to talk a little bit more about reverse mortgages, go over some of the normal questions that come along with them. And so today, because this reverse mortgage business has been around for a while, but it's become more popular over the last, I'd say, 10 years. And so most reverse mortgages today are called home equity conversion mortgages. Home equity conversion mortgages, or HECMs in the mortgage world. We call them HECMs, okay? And HECMs are federally insured by the Federal Housing Administration, or FHA. Most of you guys have heard of them. And those are the loans that I've been focusing on, the HECMs, the home equity conversion mortgages that are tied to FHA, okay? So there are some non-HECMs out there, and they may have a few different guidelines, so you'll have to do your research on both kinds if this is something that you or your family members are interested in. But today and last week, we're focusing on the home equity conversion mortgages, okay? Now, some people say, well, man, if the bank is paying me, that sounds like it's free money. No, that's not true. Reverse mortgages are not free money. They are loans that the borrowers and their heirs will eventually have to pay back, usually by selling the home, okay? So it's not free money. The home does have to be, or that mortgage does have to be paid back, and it's typically by selling it, okay? So let's answer some of the other questions about what happens when it's time to pay a reverse mortgage off, all right? So the question may be, well, how does a reverse mortgage work if I still have a traditional mortgage? So say you're a couple, 62 years or older, you're thinking about getting a reverse mortgage, but you already have a home mortgage, right? All right, well, if you have a current home and you still owe money on that home, basically what you're doing is trading one loan for another. I think of it kind of like when you do a refinance, you're paying this other loan off to get this new loan. So if you have a home and you already owe a mortgage, you're basically going to be trading that old home, going to pay that off with the loan for the reverse mortgage, okay? And so some of the reverse mortgage will be used to pay off your current mortgage, right? And if you owe a lot on your current mortgage, you may not have much money from the reverse mortgage left over to spend on other things. Because remember, the goal of it is to have additional living expenses. So say you have a home and you owe a whole lot on that mortgage. If you're going to get a reverse mortgage, you may have to pay off so much that you don't have as much left that you wanted, right? Or if you owe too much on your current home and you don't have enough equity in that home, then you wouldn't even be able to get a reverse mortgage, all right? So you have to think about those things if you already currently have a mortgage. Like I said before, a reverse mortgage is with a reverse mortgage, equity is key. So if your reverse mortgage balance is less than the value of your home, you're in good shape. You do it just like you would if you were selling a home. Now, on a traditional mortgage, if your loan balance is more than the value of your home, on a traditional mortgage, right? So say you have a home that you owe $110,000 on, but the value of the home is only $100,000. You owe $110,000, the value of the home is $100,000. In that case, typically you're called what they call upside down or underwater. And so if you were trying to sell that home and you really needed to get that home sold, that $10,000 difference, you're going to have to come out of your pocket to make that difference, right? That's how it works on a traditional mortgage. Well, when you're dealing with a reverse mortgage, if your loan balance is more than the value of your home, you may not have to pay the difference. So that is one of the benefits, and let me tell you a little bit about how that works. So when you sell your home for the fair market value, you know, when you get a home, you have to get it appraised, all of that good stuff. When you sell it for the fair market value, then the remaining balance on the loan, say you sell it for the fair market value, you only have to pay either the fair market value or 95% of the loan balance, whichever is less. And so say if you are upside down a little bit, then the mortgage insurance kicks in and pays that for you. All right, so that's a benefit, but like, what is mortgage insurance, okay? And so for those of you who've ever bought a home, you may know this, but for those who never have, I'll go ahead and explain it, all right? So on a traditional mortgage, you pay for mortgage insurance if you put down less than 20%, like when you're buying a home, right? If you put down less than 20%, you have to pay mortgage insurance. Or if you're doing like a refinance, when you're buying a home or you're refinancing a home, if your loan to value is greater than 80%. Okay, so let's break those numbers down. LTV, loan to value, that's what that stands for, and it relates to the value in your home. So if your home is valued at $100,000 and you owe $80,000, or you get a loan for $80,000, then your loan to value is 80%. Okay? So it's talking about how much of a loan you have as it relates to the value of your home. So if your LTV, or your loan to value, is 80% or less, then you don't need mortgage insurance. All right? But if your loan to value is greater than 80%, or you were buying that house and you didn't have the full 20% to put down, then you do need mortgage insurance, okay? And that's an additional expense that you have to pay for in getting the loan, okay? And so the reason that you get mortgage insurance, you would think mortgage insurance, it would protect me. No, mortgage insurance doesn't protect you. Mortgage insurance protects the lender, all right? So typically with mortgage insurance, you have to pay for it, all right? Because basically it's like you're not bringing the whole 20%, but we're gonna let you go ahead and get this home, but you're gonna have to pay for this mortgage insurance. Now there are some lender paid mortgage insurances, but those are normally attached to your rate, and they make your rate go higher, all right? But I won't get in the weeds on that, because that could be a whole nother conversation, all right? But the reason we're talking about this now is with mortgage insurance on a traditional loan, you get it if your loan to value is greater than 80%. You pay for the mortgage insurance. It protects the mortgage lender in case you default on the loan and stop paying, all right? So if you default on your loan, then the lender typically is going to take you through foreclosure, right? And then there would probably be a sale, because they're going to try to recoup the money that they've already given to you. And so say, for instance, that happens and they're not able to recoup all of the money. Say the house, they gave you $100,000, but they were only able to get $87,000 in the sale of the home, then the mortgage insurance is what pays the difference for them, all right? And that's how it works on a traditional mortgage. So now, going back to the point I was making before, on a reverse mortgage, okay, when it's time to pay off your home, or when it's time to pay that mortgage loan off, you have to do one of two things. You have to either pay 95% of the appraised value of the home, or let me do it right, 95% of the appraised value, or the full loan balance, whichever is less. That's what you would have to pay. So if you were paying off the 95% of the appraised value, you see there's 5% left. That's where that mortgage insurance comes in and pays that difference for you. So in this case, that really is a decent benefit of a reverse mortgage, in my opinion. All right. So if you do have a reverse mortgage, or you're thinking about reverse mortgage, and you want to leave that property to your heirs, then you and your heirs are going to need to talk about what the payoff options are, okay? Because if they want to keep that home, you say, hey, I want my daughter to have this home, but you've got this reverse mortgage, and she's like, well, I'm going to try to pay for it myself, then she's going to have to pay either 95% of the appraised value or the loan balance, whichever is less. Okay, so again, that's a conversation that you need to have, I think, up front, especially if you plan on leaving that home to your children. So as with anything that we've talked about, you need to do your own research, okay? Reverse mortgages can be pretty complicated, and it's hard for people to kind of grasp the concept. So my hope is that I've helped you to do that a little bit more today, okay? And just as I stated before, when all of the borrowers no longer live in the home, then the reverse mortgage has to be paid off. Well, where would that come into play? Well, say you have a married couple and only the husband is on the loan. If he's the borrower and say they get divorced and he leaves the house, or he passes away, then the wife has to repay that mortgage then, okay? So that would be a conversation you might want to have with someone who's living in the home who's not a borrower on a reverse mortgage. You want to get all of that stuff lined up and understand what happens when it's over, because there have been cases where people, husband and wife, or maybe you're not husband and wife, girlfriend, boyfriend, whatever, only one person is on that reverse mortgage. The other person is not informed about how it works. And so when that other person leaves or dies, then the spouse or the partner who's been living in this house for all this time, they got to leave unless they have the money to pay that mortgage back, okay? All right, so that's how that works. And then the home must be, for a reverse mortgage, it must be your principal residence. It's not a house that you can, rent out to somebody or whatever. You have to be living in the house. And then in addition, there's some other pay options even for the home equity conversion mortgages, the HECMs. There's some other payout options that you can use, and there's a lot of information about it. So I'm not going to get into all of that here because we could be talking forever, but I am putting a link in the notes. Gives you the information as it relates to the Consumer Protection Bureau, because remember we talked a little bit about them last time, and they try to protect consumers and they look at it from the consumer point. So this is a guide that kind of tells you all of the basics that you need to know about the home equity conversion mortgages, or the HECMs, in case this is something that you choose to do. All right, I hope that I've at least helped you a little bit, and if you know of anyone who wants a reverse mortgage, please have them talk it through with a reverse mortgage professional. And if they plan to leave the house to any heirs, the heirs need to be in on that conversation because they need to understand what needs to happen if they plan to keep that house, okay? All right, thank you.